Welcome back to the Short Put Masterclass. My name is Stephen Cox and I'm the CEO of Navigator and I'm a full-time options and futures trader. This is episode 4 in a 6-episode masterclass on the short put strategy. In the previous 3 episodes, we discussed why the short put strategy is one of our favorite option strategies because it's a high probability strategy and we get paid for selling time value in an option. We also discussed the S&P 500 ETF SPY and why you can get a statistical edge by applying the short put strategy to SPY. We also discussed 2 of the option Greeks, delta and theta. And today we're going to discuss another 2 Greeks, gamma and vega. And these are the key for managing risk in volatile or fast-moving markets. But I want to reassure you at this stage, again, we're going to expose you to some mathematics with gamma and vega. But you don't have to worry about that because when you place a trade in your online broker, all of this is calculated for you. You simply need to understand what gamma and vega are and how they can impact an options price. Okay, in episode 3, we discussed what delta was. Well, gamma measures the rate of change of delta for every $1 move in the share price. So if delta is the speed, gamma is the acceleration behind the speed. And for a short put, gamma is always negative. Again, we're looking here at the option quote screen for SPY, and you can see that the gamma value is 0.005. But remember, we've sold this put option, so that becomes a negative for us. So our gamma is minus 0.005. So what is the impact of negative gamma? So negative gamma is good when you're winning. In other words, the share price is moving upwards. Your negative gamma causes the delta to move quickly towards zero. Moving towards zero means our position sensitivity to the stock price drops fast, which is great for us. But it's bad when we're losing. If the stock price moves against us, in other words, the share price of SPY starts to fall, our negative gamma causes our delta to move quickly towards minus 1. This is dangerous. Our delta, which started at minus 0.167, would accelerate towards minus 0.2, then minus 0.3, and so on. This means our losses start to accelerate the further the price drops. So our key takeaway for gamma is because the gamma with our SPY short put option is very low, minus 0.005, delta doesn't change much with a small move in SPY. This is ideal for us. Low gamma means that our short put position is relatively stable and won't suddenly turn into a high risk position. On the flip side, if our gamma was very high, then we would be at risk in our short put position for sudden moves in the share price, even small moves in the share price of SPY. Again, I want to remind you at this stage that all these calculations are done for you in your online brokerage platform. Again, we just want you to understand what these Greeks mean. So what is Vega? Well, Vega measures an option's price sensitivity to changes in implied volatility, or IV. And IV is the market's expectations of how much a stock will move. For a short put, you are selling volatility, so your position Vega is negative. I would like to emphasize that this is a really important part for you to listen into if you're going to start selling put options. And we have a couple of tips coming in the next number of slides that are going to be very important for you when we discuss IV rank. So again, you're looking at an option quote screen for our SPY put option. And you can see Vega is 0.60 and you can see our IV percentage is 20.5%. So what are the impacts of negative Vega? Well, if volatility drops, it's brilliant for us. And as a seller, we want the option premium to drop in price. So if implied volatility decreases by 1% after we enter the trade, the value of our option will decrease by 60 cents or $60 per contract. You make a profit just from volatility decreasing. If volatility rises, on the other hand, as an option seller, that's bad because the value of the option is increasing by $60 per contract. We're taking a loss just for an increase in volatility. I cannot stress enough how important it is for you to understand that. Too many people who do option courses that just focus on the positives don't correctly explain the impact of implied volatility on an options price. You don't need to know the mathematics behind it, but we're going to give you a very simple way for you to understand when you should be selling options and when you should be buying options. Some key takeaways for Vega. So we benefited by selling options when volatility is high. Really important for you to understand that part. The zero point 0.6 Vega that we have in our short SPY put is moderately sensitive to volatility, and we must be prepared for potential losses if the market suddenly increases volatility. And that brings me to a very simple metric that you can use to know when to buy or sell options, and that's the IV rank, and it's usually provided by most option providers. It goes on a scale from 0 to 100, so when you're closer to 0, you don't really want to be selling option premium, you want to be selling closer to 100. And vice versa, for option buyers, you want to be buying options when IV rank is low. Let's show you what this looks like in your online brokerage platform. So you can see for our SPY trade here, the IV rank is low, it's 13. So this actually isn't even an ideal time to be applying this trade. And if this was real life, we wouldn't put this trade on. We would wait for the IV rank to be higher. But because we're trying to demonstrate to you how you actually go and place the trade and what the short put option strategy is, we still wanted to use this example. But when you're looking at an option chain for any option, you will see the IV rank. And as a reminder, you want this closer to 50 or 60 before you start selling option premium. Selling it when it's at 13, we're just not getting paid as much premium as we could do. And what this IV rank is doing, it's ranking the current implied volatility versus the volatility over the last 52 weeks. So it's telling you it's in a kind of the low end of where volatility has been at in the past 52 weeks. So a reminder, and the final reminder, you want to sell option premium when IV rank is high. Okay, so let's summarize the Greeks. Delta, it's positive. We want share prices to go up for the short put strategy. Theta is positive. We want time to pass for the short put strategy. Gamma is negative. There's risk there in fast moves or volatile moves. And with Vega, it's negative. We want volatility to drop. And remember, sell put options when IV rank is high. Understanding these relationships is vital. When the market is calm, theta and delta are working for you with the short put strategy. And when the market crashes, negative gamma and negative vega hit you hard simultaneously. Okay, so that's it for Gamma and Vega. In the next video, we're going to move on from theory into practice. We're going to show you how to go and actually place a short put trade with an online broker. And then we're going to discuss how you're actually going to manage that particular trade as well. So it'll become more relevant. And we would encourage you to start practicing this in a simulated trading account. Really, your learning will be reinforced by doing that. And finally, we'd also like a quick mention of our mentoring service. If you'd like to fast track your learning and learn in a safe and supportive environment, I will work with you one-to-one, and it's simply the safest way for you to learn about trading options and futures. Also, if you like the content we're providing here and you would like us to provide more content on different option strategies, please like and subscribe to our channel.